Let's say I have an inventory. Okay, and then I converted this inventory into capital asset. And then this capital asset I sold. My sixth situation is going to be ulta. I have capital asset. This capital asset I converted into inventory, and then this inventory I sold. Okay, so my fifth and sixth situation, both my situations are going to be about conversions. Are you ready? Yes, in my fifth situation, I had inventory. The inventory got converted into capital asset and then I sold away the capital asset. In my sixth situation, I originally had capital asset. The capital asset I converted into inventory and then I sold the inventory. So these two things we are going to take up one by one. Now out of these two, this is the most important adjustment. Okay. Therefore, first I will discuss this with you so that once we discuss this, our foundation is nicely built. Once that happens, this is such an important point, guys. This will automatically fall easily in place for you. So we will put all the effort over here so that we already have strong foundation knowledge before we enter the sixth point. Okay, so listen to my fifth situation. In my fifth situation, I am talking about conversion. I am talking about conversion of inventory into capital asset. Alright, now this particular situation and the next situation, if you see the fifth and the sixth situation, just like that, if you try to read it from your material, or just like that, if you try to read the provision, it will sound very complicated. Too much you will have to mug up, too much you'll have to remember. So what I will do is, I will give you one simple tip, okay? That tip to follow. With that tip, you will not have to mug up anything. Everything will be pure logic. Alright, just remember this small tip. Tell me, what has happened over here? Over here, my assessee has converted the inventory into capital asset. And then, this is the first thing which has happened. And then my assessee has transferred the capital asset. Okay, do not do any writing. Just listen to me. So in this point over here, my assessee had inventory. This inventory got converted into capital asset. So now what does my assessee have in his hands now? Inventory converted into capital asset. So what does my assessee have in his hands now? Yes, capital asset in his hands, and then later he transferred the capital asset. These are the two transactions which have happened over here. Is this clear? Go step by step, guys. What has happened over here? Originally, I had only inventory. That inventory got converted into capital asset. Okay, now what do I have in my hands? Now I have in my hands capital asset. Okay, this capital asset I am transferring. This is a situation in front of us. Yes, so I had inventory in my hands originally. This inventory got converted into capital asset and then I'm transferring the capital asset. Please notice, in reality, there are two transactions. But what I am asking you to do is imagine that this is actually two transactions. This is actually one transaction only, but I'm asking you to imagine as if there are two transactions. In reality, inventory got converted into capital asset. Tell me, two people involved or one person involved? This I'm asking you to target, guys. This you leave. This will come to later. Target only this first adjustment. Tell me, one person involved, two people involved. Only me, right? Earlier it was sitting in my stock account. Now that stock account, I'm putting it into my capital asset account. So in reality, two people not involved. Me, one person only. Left hand to right hand. Just changed form, guys. I did not sell to anybody in reality. But I'm asking you to imagine that this is two transactions. In reality, this is only one transaction. I just converted inventory into capital asset, but I'm asking you to imagine that there are two transactions. In other words, imagine as if my assessee, guys, listen, inventory is converted into capital asset, which means No more inventory. Are you understanding? Inventory is converted into capital asset. It means no more inventory, no. So imagine assessee sold the inventory. Imagine he sold the inventory. What does assessee have in his hand now? Inventory got converted into capital asset. So what does he have in his hand now? Capital asset. So imagine assessee purchased the capital asset. Okay, tell me, in reality, did assessee do all this? No. In reality, he had inventory. The inventory he converted into capital asset. That's all. Earlier, he was a jeweler. So jewels he had was his inventory. He decided to close down his jewelry business. So whatever jewels he had, he brought those jewels home. So jewels which were earlier his inventory became capital asset. In reality, only this conversion happened. Jewels which were his stock in trade, which were in his shop earlier, have now come home. Inventory got converted into capital asset. In reality, this is what happened. But I'm asking you to do imagination. Inventory is converted into capital asset, which means no more inventory. So imagine we sold inventory. What do I have in hand now? Capital asset. Imagine I purchased capital asset. Okay, now tell me, if assessee sold inventory, which head of income will come into the picture? If I say assessee sold inventory, PGBP will come into the picture, guys. Total logic, just follow what I'm telling you. Assessee sold inventory, I'm asking you to assume, it means PGBP comes into the picture. PGBP, I need selling price. Tell me, in reality, did my assessee sell the inventory? No. I am imagining he sold the inventory. So in my imagination, if I go to the market to sell the inventory, at what price I will sell the inventory, guys? I will sell the inventory at FMV. FMV on which date? On the date of conversion. All this is happening on the date of conversion, right? So you will take FMV on the date of conversion. Clear, clear, clear? On the date of conversion, in reality, only conversion happened. Nothing else happened. But I'm asking you to assume. I'm asking you to imagine. In reality, inventory got converted into capital asset. That's all. But I'm asking you to imagine, what if I sold the inventory and purchased capital asset? Why am I asking you to imagine like this? Because inventory got converted into capital asset, which means no more inventory, which means I sold inventory. What do I have in my hands now? Capital asset, as if I purchased capital asset. So I'm asking you to imagine I sold the inventory and purchased the capital asset. When I sold the inventory, PGBP will come into the picture. PGBP, I need selling price number. In reality, I did not sell. But had I sold inventory, I would have sold for fair market value. So I'll take the FMV number as selling price. Okay, this over. Now listen. Assessee purchased capital asset. If assessee is going to purchase capital asset, any head of income will get affected? No. When will head of income be affected? When you purchase the capital asset and later transfer the capital asset, this is where capital gains will come into the picture, guys. Agreeing? When will capital gains come into the picture? When you purchase capital asset, why will capital gains come in, guys? Capital gains will come into the picture only when you transfer the capital asset. No. So when you transfer the capital asset, there will be capital gains. Now, how will you compute the capital gains? Our usual steps you will follow. What's my first step? Tell me. Capital asset. So you will write capital asset jewels. Then period of holding you need. When will period of holding start? On the date of conversion, you're going to assume you purchased the capital asset. No. So don't you think period of holding will start on the date of conversion? Because when you're doing this conversion, on that day you're assuming you purchased capital asset. Is it falling in place? Is everything falling in place? No need to mug up anything. Pure logic, guys. Assessee purchased capital asset when in reality did not purchase. In reality converted only. But I'm imagining on the date of conversion, I am imagining assessee purchased the capital asset. So if the assessee purchased the capital asset on this date, then that will be your starting point of period of holding. When will period of holding end? Period of holding will end on date of transfer. Whatever is the date of sale, whenever you're doing this transfer, period of holding will end. Then what's your next step after this? You start the computation. Full value consideration will be what? Whatever is your selling price for how much ever you're transferring, that will become your full value consideration. Now tell me, what will be your cost of acquisition? In reality, did you purchase capital asset? No. But what are we assuming? On the date of conversion, I am assuming you purchased capital asset. So had you purchased capital asset on the date of conversion, for how much you would have purchased? You would have gone to the market and you would have paid FMV, guys. FMV on which date? When are you purchasing? I'm assuming you're purchasing upon conversion. No. So cost of acquisition will be FMV on the date of conversion. That's all. Nothing to mug up. Everything pure logic. Just do this imaginary assumption. Otherwise, generally, students sit and mug up. Okay, when I sell inventory, PGBP selling price will be FMV number. That same FMV number will become cost of acquisition later. Like that, students sit and mug up. I don't want you to do any mugging up. Only then you will remember. If you're going to do any mugging up examination, you will forget off. Okay, is this crystal clear? So when I convert inventory into capital asset, I was a jeweler. I was having jewels in my shop. They were my inventory. I shut down my jewelry business. So those jewels, leftover jewels, I brought home. So my inventory jewels got converted into capital asset jewels. So when in reality, I did only one thing. I converted my inventory into capital asset. But this transaction, I'm asking you to imagine that there are two things. Inventory is converted into capital asset, which means no more inventory, which means imagine I sold inventory. What do I have in my hand? Capital asset. Imagine I purchased capital asset. So on this date of conversion, imagine that I sold the inventory and purchased the capital asset. So when you sell the inventory, which head of income will be involved? When you sell the inventory, PGBP will be involved. In reality, you did not sell. But had you sold, you would have sold on at the FMV value. Okay. When you purchase the capital asset, no head will be involved. Only when you transfer the capital asset, capital gains will be involved. Under capital gains, your period of holding will start on the date of conversion. Because on the date of conversion only, I am assuming that you purchased capital asset. So the date of conversion will be your starting point of period of holding. Your cost of acquisition, in reality, you did not pay to acquire this. But I will imagine that what if you had paid? If at all you had purchased the asset, you would have purchased it by paying FMV. FMV on this date. So FMV on date of conversion you take. Can I close the fifth situation? Can I take you to the sixth situation now? Yes, guys. Can we go to situation number 6? Come on. So with this, we've learned this one. Now I'm taking you to the sixth one. This is the situation. All right. Listen to me. In the sixth situation, again, I am talking about conversion. This time I'm talking about conversion of capital asset into stock in trade. I'll give you an example first. Let us say I had jewels at home. So they were my capital asset. Later, I decided to start a jewelry business. So therefore, the jewels which I had at home, I took them to my shop. Possible. So the jewels which were at home, which were my capital asset earlier, those jewels now became my stock in trade, guys. In reality, if you see, there are two transactions which happened over here. In reality, if you see, First of all, capital asset I converted into stock in trade. And secondly, that stock in trade which I have in my hands now, that stock in trade I sold. Very similar to this. In reality, two transactions have happened. First of all, capital asset I converted into stock in trade. So now what do I have in my hands? Stock in trade. And then that stock in trade I sold. My whole focus is only on the first point over here. Okay, my whole focus is on only this first point here. In reality, only one thing has happened here. In reality, whatever capital asset I have, this capital asset got converted into stock in trade. In reality, only one transaction has happened over here. I am focusing only on this first one. But same thing, I will ask you to imagine that two things happened here. Tell me what are the two things that you will imagine here? Capital asset got converted into stock in trade, which means no more capital asset. So what will you assume? You'll assume that you transferred what? You'll assume that you transferred the capital asset and what do you have in your hands now? You have stock in trade in your hands. So you will assume that you purchased the stock in trade. Understanding? In reality, did you sell the capital asset? In reality, did you purchase stock in trade? No. In reality, you already had capital asset, and capital asset you just converted into stock in trade. One hand to another hand, one account to another account. Same person, another person also not involved. In reality, there is no movement as such. I just passed book entries converting capital asset into stock in trade. But I'm asking you to imagine I have converted capital asset into stock in trade, which means I don't have capital asset anymore, which means treat as if I transferred the capital asset. Suddenly I have stock in trade in my hand. So imagine I purchased the stock in trade. Now tell me, if you transfer capital asset, which head of income will be involved? Now, come on. Now, this is where the real game is. Tell me, when you transfer the capital asset, now tell me, which head of income will get involved? When you transfer the capital asset, capital gains head of income will be involved, guys. Capital gains, how do you do your usual steps? First of all, you will start with capital asset. Capital asset, whatever, in our example, capital asset is jewels. Okay, then will be your period of holding. Period of holding, when will it start? Whatever was your date of acquisition, whenever you purchased the jewels long back, that is when your period of holding will start. But tell me, when will your period of holding end? When are you transferring? What am I imagining on this date of conversion? I'm imagining you are transferring, guys. So when did the date of transfer happen? On the date of conversion itself, transfer has happened. But tell me, in reality, did I sell away the capital asset? No. In reality, I did not. But I'm asking you to imagine. Imagine you had sold away the capital asset on this date. In reality, only conversion has happened. But on this date of conversion, I'm asking you to imagine I sold away the capital asset. So when did I sell the capital asset, guys? On this date, on the date of conversion, I have sold away the capital asset. Then you will enter the full value consideration. Do I really have a full value consideration? Did I really sell away the capital asset? No. I am imagining, what if I sell away the capital asset on this date? For how much would I have sold away the capital asset? I would have sold it for the FMV number, guys. FMV on which date? On the date of conversion. In reality, I did not sell away the capital asset. But had I sold the capital asset according to my assumption on this date, I would have gone to the market and I would have sold it at the market value. So whatever is the FMV on the date of conversion will become my full value consideration. Has it all fallen in place? Absolutely no gaps in understanding? Yes, guys. Perfect clarity. Now listen. This is about transfer of capital asset. When you purchase stock in trade, will any head of income be affected? No. But when you sell the stock in trade, now PGBP will come into the picture. When you sell the stock in trade, PGBP will come into the picture. So selling price will be whatever is your actual selling price, you consider that. What will be your cost price? Tell me, did you actually pay anything to buy the stock in trade? No. But I am imagining on this date of conversion, I am imagining I purchased the stock in trade. So had I purchased the stock in trade on this date, for how much I would have purchased the stock in trade, guys? I would have gone to the market, I would have paid the fair market value. So that same fair market value on the date of conversion, that will become my cost price. My balance number will become PGBP. Except one point, everything else covered. In reality, I did not purchase any stock in trade, but I am imagining, what if I had purchased stock in trade on the date of conversion? Then how much would I have paid? I would have paid how much? I would have paid the FMV. So whatever is the FMV on the date of conversion, that will become my cost price. Okay. Yes, guys. So are you noticing in this entire conversion discussion, what is your most important number? What is that one number which you are using everywhere? Are you noticing? This FMV number on the date of conversion, this number becomes extremely important. You end up using this number in multiple places. One last concept is left. Can I take that up for you now? Under this itself. See, listen. When did capital gains arise? When you converted your capital asset into stock in trade, you treat it as if you transferred capital asset and capital gains have come into existence here. But tell me, did you actually sell away any capital asset? No, I'm only assuming that you transferred the capital asset. In reality, you did not sell away any capital asset. So are you noticing that because of this imaginary sale, there is going to be a tax burden on you? In reality, you did not transfer any capital asset, guys. In reality, only conversion happened. In reality, you did not sell away any capital asset. So because you did not sell away any capital asset in reality, tell me, is there any money inflow for you? Has money come in for you? No. In reality, if you see, no money has come in for you. In reality, there is only change of form. In reality, there's no sale money coming in for you. So, but still, if I ask you to pay tax on this capital gains, on imaginary sale, if I'm going to ask you to pay tax, don't you think it will be unfair? Because you did not even receive any money in hand, I am still asking you to pay tax. So that is why the Income Tax Act is doing a favor on us, and Income Tax Act is saying that, listen, assessee, when you convert capital asset into stock in trade, yes, I will assume that there is transfer. Yes, there will be capital gains. But don't worry, assessee. Now itself, immediately itself, no need to pay tax. We will wait and see. When will money come in? When you sell the stock in trade, at this point at least money is going to come in. So when you sell the stock in trade, in that year you pay tax. Are you understanding? So when I convert capital asset into stock in trade, capital gain is coming into the picture. I am imagining I transferred a capital asset and I am doing capital gains computation. But Income Tax Act is understanding the fact that this is only imaginary transfer. So in reality, no money has come in, no sale price, no sale revenue has come in, no sale proceeds have come in. So Income Tax Act is understanding that where will I take the money from to pay tax? So Income Tax Act is saying, don't worry, assessee, there is transfer, there is capital gains, but don't worry, immediately you don't have to pay tax. We will wait and see. When is money coming in? When will money come in? When you sell the stock in trade, money will come in. So we'll wait and see that when are you selling the stock in trade. Whenever you sell the stock in trade, that time money will come in. That time you pay tax. Okay, so listen, what is my general rule, guys? My general rule is that whenever the transfer happens, in that year, the taxation will happen. But don't you think this is an exceptional case? In this situation, when is transfer happening? Whenever you convert the capital asset into stock in trade, at this stage itself transfer is happening. But am I going to expect you to pay tax now itself? No. When will you pay tax? Only when you sell the stock in trade, only then you will pay tax. Okay, so whenever the conversion is happening, whenever you convert the capital asset into stock in trade, at that time itself, transfer is happening, no doubt. But no need to pay tax now itself. I will wait and see. When are you selling the stock in trade? So whenever you sell the stock in trade, that time only you will get the money inflow. That time only you pay tax. So my general rule is that whenever the transfer happens in that year, you pay tax. But yes, I do have exceptional cases. And in these exceptional cases, I have totally 4 exceptional cases, guys. We've already learned one exceptional case. Second situation, we've already learned it. This is the second time we're coming across this exception. In conversion of capital asset into stock in trade, whenever the conversion happens, transfer happens right then. But I will not ask you to pay tax right away. I'll ask you to pay tax only when you sell away the stock in trade. This was my entire discussion with you with respect to conversion of capital asset into stock in trade, as well as conversion of inventory into capital asset. Both you've understood, guys, that exceptional case will not apply here. Okay, this exceptional case is only for capital asset into stock in trade. Logic, if you understand, you'll understand why. Okay, so so both the situations will become very easy if you imagine that the first situation has 2 parts. The first transaction, if that conversion transaction, if you split into 2 transactions, then everything becomes very logical and very to the point. Confident? Are you ready to take up questions on this whole thing now? Yes, 2 provisions we've learned: converting inventory into capital asset and converting capital asset into stock in trade. Okay, let's take up a question. Let's work out this entire discussion. I'll bring a question to your screen. Question number 15, guys. This question we are going to work out. Let's read the question first. X invested 1 lakh on the purchase of gold ornaments on 4th Jan 2005. Guys, only one reading we can afford, be careful. He invested 1 lakh on the purchase of gold ornaments on 4th Jan 2005. He holds the gold ornaments as investment. On 12th Jan 2015, he started a business of dealing in jewels and he converts his holding into his stock in trade. Understood? Earlier gold ornaments were his investment, which means earlier gold ornaments were his capital asset. He started jewelry business in 2015. At that time, he converted his capital asset into stock in trade. So what is your date of conversion? 12th Jan 2015. Market value of the gold ornaments on the date of conversion was 4 lakhs. You know how important this number is? This is your FMV on the date of conversion. X credited his capital account by 4 lakh and debited his stock account by 4 lakh. I don't care what are you doing in accounts because I am doing tax calculation over here. The gold ornaments are now reflected in the business of X as stock in trade. These gold ornaments were sold in the previous year 23-24 for 5 lakh rupees. So earlier you had capital asset. That capital asset you converted into stock in trade. Then you later sold away the stock in trade for 5 lakhs. Compute the capital gains and business income. Till here we'll handle first, then we'll come to the second subdivision. Are you ready? No need to think too much, no further analysis. Just like how I've told you to handle all the questions in the past, same way I'm going to do this question also for you. I've read the question and now I'm straight away going to start writing. I'm straight away going to fit everything into my format. What's the first thing we do right after this? Tell me. After reading the question, the very first thing, capital asset. What is the capital asset in this question? What are we transferring? What are we converting? We are converting capital asset into stock in trade, right? What is our capital asset over here? What are we transferring? Gold ornaments. See, in reality, listen. In reality, how many transactions happened? 2 transactions happened. I had gold ornaments, which were my capital asset. These gold ornaments I converted into my stock in trade. And then later what I did? I sold the stock in trade. In reality, there are 2 transactions. But this first transaction, I will split into how many parts? This first transaction, I will split into 2 parts. Capital asset got converted into stock in trade. No capital asset anymore. So I will treat as if I transferred the capital asset. Suddenly, what do I have in my hand now? Stock in trade. I will treat as if I purchased the stock in trade. When did this conversion happen? This capital asset got converted into stock in trade on 12th Jan 2015. On this date, I will assume I transferred capital asset. So if I transferred the capital asset, then which head of income will be involved? If I transferred the capital asset, capital gains head of income will be involved, right? In reality, I did not sell away the capital asset. I am imagining I sold away the capital asset on this date. So capital gains head of income will be involved. So tell me, what is a capital asset I've transferred? I'm imagining what did I transfer? What converted into stock in trade? Gold ornaments. So my capital asset is going to be gold ornaments. Okay. What will be my period of holding? When did I acquire the gold ornaments? 4th Jan 2005. In reality, I did not sell, but I will imagine I sold on the date of conversion. So when will my period of holding end? On 12th Jan 2015. What will be my full value consideration? In reality, I did not sell the gold ornaments, but had I sold on this date, for how much I would have sold? What is the FMV on the date of conversion? 4 lakhs. Perfect clarity. Same thing I'm going to do for you here. Yes, so capital asset is gold ornaments. I'm going to imagine that these gold ornaments, which were my capital asset, I'm imagining I've transferred them. Then second step, write down period of holding. When will my period of holding start? I acquired the gold ornaments on 4th Jan 2005. In reality, I did not sell them. But on 12th Jan 2015, I'll assume that the transfer has happened. On the date of conversion, I'll assume that the transfer has happened. Will I write a note over here? Try to recall the rules I've given you. Will I write any note over here? Yes. I've told you, right, in those 4 exceptional cases, I will put a note over here. Liquidation was one case. And now conversion is also an exception. Even in conversion, I've created an exception. So here also I'll have to put a note. So write down upon conversion of capital asset into stock in trade, comma, transfer is deemed to have taken place. However, capital gains computed below will be taxed. However, capital gains computed below will be taxed only upon sale of stock in trade. Capital gains computed below will be taxed only upon sale of stock in trade. Under this, give your computation heading. Then start your usual steps. What's your step? Full value consideration. I've told you in reality, I haven't sold the jewels. Had I sold the gold ornaments, I would have sold for FMV on the date of conversion. So on this date, FMV is 4 lakhs. Less expenses on transfer, we don't have any. So this 4 lakh as it is becomes our net consideration. Can I index the cost of acquisition? See, 4th Jan 2005 to 12th Jan 2015. This is definitely more than 24, 12, 24, 36. What will be the relevant period of holding? Jewels, guys, this is going to be 36 months, right? So this period is definitely more than 36 months. Therefore, what kind of an asset is it? Long-term capital asset, which section? 112, you know all this. So less index cost of acquisition. It is a long-term capital asset. Therefore, I can index it. It is not bonds and debentures. It is not unlisted securities, non-resident Indian company, foreign currency, you know it. It is also not depreciable asset. It is not slump sale. It is not 112A. It is also not market-linked debentures. That whole list of exclusions is not applicable. So can I index the cost of acquisition? Yes. So here I'm not putting separate working notes, guys. We've done good number of questions. You would be used to it by now. So what is the cost of acquisition? Long back we had purchased it for 1 lakh rupees. 1 lakh into what is a year of transfer? See right here, what is a year of transfer? 1415, right? So 1415, what is the indexation? 240. 1415 indexation is 240 divided by what is a year of acquisition? The year of acquisition is 2004-5. 2004-5, see the indexation? 113. Okay. So 1 lakh into 240 by 113. How much will this work out to? 2,12,389. We don't have any cost of improvement. So what is our LTCG number? 1,87,611. Do you get this number, everybody? Yes. But when will we tax it, guys? Will we tax it upon transfer? No. This is conversion of capital asset into stock in trade. This is one of the exceptions. Right? Right now, I don't have any money in hand because in reality, I did not sell away the capital asset. So no money inflow. From where will I take money and pay tax? So I'll wait. I'll wait till I sell the stock in trade. When did we sell away the stock in trade finally, guys? See, the question says we sold the stock in trade finally on in 23-24. So it will be taxed upon sale of stock in trade, that is assessment year 24-25, previous year 23-24. Perfect clarity? Yes, this adjustment is generally considered to be a little tricky by the students, but I'm hoping you're comfortable. You understood what you've written? Does it make solid sense to you? Yes, I just imagined that I sold the capital asset. In reality, I did not. So had I sold the capital asset, I would have sold on the date of conversion for 4 lakh rupees. So with that in my mind, I've done my whole calculation. But in reality, I did not sell. No. So there's no money inflow. If no money inflow, from where will I take tax and pay you? So therefore, I will wait till I sell the stock in trade. Only then I will tax the capital gains. Now, in 23-24, in previous year 23-24, we sold the stock in trade, guys. So assessment year 24-25, previous year 23-24, when we sold the stock in trade for 5 lakhs, don't you think there will be PGBP also when I'm selling stock in trade? Same thing, guys. When I purchase stock in trade, nothing to do. When I sell the stock in trade, there will be PGBP. So PGBP, how will you calculate? What will be your selling price? But how much did you sell the jewels? For 5 lakh rupees. What will be your cost price? Tell me, in reality, did you purchase the stock in trade? No. But on this date, had you gone and purchased the stock in trade, for how much you would have purchased? FMV 4 lakh rupees. So the balance 1 lakh becomes PGBP. Same thing we're going to write down. Write down sale price 5 lakhs less FMV on date of conversion 4 lakhs. So the balance 1 lakh will become your business income for this year. Got it? Okay, so that's it about our discussion with this part. So in 23-24 itself, you're going to tax so much capital gains also, and you will tax so much business income also. So always remember, when you convert capital asset into stock in trade, the year in which you sell your stock in trade, in that year, you will have two implications. You're understanding? Whenever you convert capital asset into stock in trade, later when you sell your stock in trade, you will have two implications. PGBP you will anyways have because you sold stock in trade. Also, the capital gains which had arisen earlier, even that you will tax now. So when you convert capital asset into stock in trade and later when you sell that stock in trade, you will have two implications. PGBP you will anyways have, capital gains also you will have. But capital gains arose earlier itself. You're only taxing those capital gains now. All right, that is it about the first subdivision, guys. In addition to this, they're also asking us what would be the answer if the gold ornaments are held by the assessee till 31st March 2024. Held by the assessee, which means what? Assessee did not sell the stock in trade. So if he did not sell the stock in trade, neither will he have PGBP nor will the capital gains be taxed. Because when will we tax the capital gains? Only once you sell the stock in trade. So if you don't sell the stock in trade, PGBP you will anyways not have. Even the capital gains which you have computed and kept over here will not be taxed in the current year. We'll wait and see when are you selling the stock in trade. In that year, I will tax it. Okay, so come on, write down the last part of the answer to subdivision B. Write down, if the gold ornaments, in brackets write down stock in trade, are held by the assessee till 31st March 24. That is, if they are not sold, that is, if they are not sold by the assessee in previous year 23-24, that is, if they are not sold by the assessee in previous year 23-24, then under this write down the first point, business income will not be taxed in, business income will not be taxed in previous year 23-24, 24-25 assessment year. Capital gains computed above, rupees 1 lakh 87,611 will not be taxed in previous year 23-24, assessment year 24-25. They will be taxed only upon sale of stock in trade. They will be taxed only upon sale of stock in trade. Done, everybody? Yes, that's it with this question. All right, a very good question this was. This question tests you entirely with respect to this adjustment of conversion. All right, so keep the entire logic in your mind. All right, do not mug anything in the situation. Okay, do it with proper logic. Remember, I will not tax the capital gains immediately. I will tax them only when you sell away the stock in trade. With this, we come to an end to our sixth situation also. All right, solid learning we've done in this session.